A young entrepreneur walks into a bank. He has an idea, a small factory, maybe a logistics company, maybe software, maybe a hotel near the Adriatic Sea. The banker looks at him and says, "Too risky, no collateral, no long history, no perfect balance sheet, so the business does not happen." Now enter the central bank. The central bank says, "Fine, I will give commercial banks money at almost zero cost. I will even guarantee part of the risk. Now lend." And suddenly, the loans begin flowing. Sounds good, right? But here is the dangerous question. What happens when money becomes too cheap? Most people think banks lend existing money. That is not entirely true. When a commercial bank approves a loan, it actually creates new money digitally. A loan becomes a deposit. Modern banking works because banks create credit, but central banks operate at a different level. They create what economists call base money, reserves, liquidity, the foundation of the monetary system. So when a central bank gives banks funding at 0%, it is not moving old money around. It is creating new liquidity. And this is where the philosophical battle begins. Supporters of cheap money say, without intervention, banks become too conservative, especially after crises. SMEs suffer first. Small businesses cannot compete with large corporations for financing. So central banks intervene to save jobs, investment, production, and economic growth. In this view, cheap money is not destroying the market. It is saving the market from paralysis. And honestly, sometimes this argument is correct. But critics ask a terrifying question. What if cheap money starts replacing real market discipline? In a normal market, interest rates are signals. They tell us who is productive, who is risky, who deserves capital, and who does not. But if money becomes artificially cheap for too long, those signals become distorted. Weak businesses survive. Risky projects continue. Banks stop caring about proper risk analysis. And suddenly, competition itself changes. The winner is no longer the most efficient company. The winner becomes the company closest to subsidized money. That is a completely different economy. Economists even have a name for this. Zombie firms, companies that should normally disappear, but survive only because credit remains artificially cheap. Japan experienced this after the 1990s. Europe saw elements of it after 2008. And when zombie companies survive, productivity falls, innovation slows, real competitors suffer, and the economy quietly becomes weaker. Not immediately, slowly, like a tree rotting from the inside. So how far should a central bank go? That is the real debate, because central banks today are no longer just controlling inflation. Increasingly, they influence where capital flows in society, who receives financing, who survives, who expands. In other words, they are shaping the structure of capitalism itself. And this creates the great modern dilemma. If central banks do too little, the economy may collapse. If they do too much, the market itself may stop functioning naturally. Cheap money can save an economy, but cheap money can also slowly weaken the invisible intelligence of a market. Because markets are not only built on money, they're built on signals. And when signals become artificial, even intelligent people begin making irrational decisions. This is Gavril Talk Business. See you next time.